XYZ Limited owns certain plant and machinery whose written down value on 1/4/2012 is 5 lakh and the rate of depreciation to the block to which it belongs is 10%. Okay, so we have a plant and machinery here. Which is 10% block. Opening written down value is given to be 5 lakh. Let's read it again. The company acquired 2 additional plant and machinery of the same block as under. Add. So there were 2 plant and machinery which were acquired. One is for 50,000. The date is 1/6/2012 and the second is 1/12/2012 which is for 1 lakh. Very good. The company also sold an old plant and machinery for rupees 2 lakh. You are required to calculate depreciation for assessment year 2013-14. Less sold during the year. How much is it sold for? It is sold for 2 lakh. Minus 150 plus. So what is the closing value? 500 plus 150 minus 200, which is 4,50,000. Now you are told to find out the depreciation. Now depreciation, as we know, has to be calculated at the prescribed rate. But one important thing which needs to be noted here is that out of these 2 assets, one of the assets was put to use for more than 180 days. The assumption we are making here is the date of acquisition is also the date of put to use, right? But the second one has been acquired for less than 180 days, which means what? We have to allow depreciation proportionately. So we will have depreciation on 1 lakh for 5%. Why? Because 10% is the rate. We have reduced this to 50%. And depreciation on 3,50,000 at the rate of 10%. So this will be 5,000. 10% will be 35,000. So your total depreciation will be 40,000. The written down value will be 4,10,000. The second question you were asked is indicate whether there are any capital gains. Now we know that capital gain arises only if either all the assets are sold, which is not the case here, right? Or the sale consideration exceeds the total value of the block. Total value of the block was how much? 6,50,000. Sale consideration was 2 lakh. Hence there is no capital gain. No capital gain. Right? The second question is, what would be the capital gains if the plant and machinery was sold for 8 lakh? Now just have a look out here. If plant and machinery is sold for 8 lakh, the total value of the block was how much? 5 plus 150, which is 6,50,000. If you sell the block, some machinery for 8 lakh, which means there is a gain of 1,50,000. Now in this case, the condition that the sale consideration exceeds the total written down value of the block is true, right? Therefore, there will be no depreciation in this year, and this excess of 1,50,000 will be short-term capital gain, right? This is something which we learned from the theory section. You can just go and have a look at that video again, which is titled Short-Term Capital Gain on Depreciable Assets. On a going forward basis also, even though there are these plant and machinery which might be forming part of the block, no depreciation will be allowed. Why? Because the entire value of the block has been exhausted, right?